Hi guys, this is Sia Jane and welcome back to my channel ACCA and beyond. So in today's chapter, in today's video is going to be about chapter number 11, which is completion and review. So once you're done with all your substantive testing, you might think, okay, great, audit done. But nope, not yet. There are still a few more important procedures left before the auditor can actually sign the audit report. And one of the biggest ones is subsequent events. So, what exactly are subsequent events? In simple terms, these are events that happen after the reporting date but before the auditor signs the report, or even things we come to know after the report is signed. Now, why do we care? Because some of these events can actually impact the financial statements, and we need to make sure they are properly dealt with. According to ISA 560, the auditor has two main responsibilities here. First, we need to gather enough appropriate evidence to check are all important events properly existed or disclosed in the financial statements. Second, if something comes up after the audit report is signed, we can't just ignore it. We have to respond appropriately. Now, IAS 10 makes this even easier by classifying subsequent events into two types: existing and non existing. And trust me, this classification is everything for your exam. Okay, so let's actually understand the most important part, which is existing events versus non existing events. This is where students either score or lose marks. First up, existing events. Think of these as this problem already existed at your end, and we just got more information later. So basically, these events give us extra evidence about conditions that were already there at the reporting date. And because of that, we need to adjust the financial statements. Some quick examples to log this in: damaged inventory or doubtful receivables. Okay, the issue already existed. Now we have clearer numbers. Insurance claims being negotiated. Now we finally know how much we'll get. Sales or purchase price of assets decided after the year end, but the transactions relate to before year end. Tax liability agreed. Again, it existed earlier. Now it's confirmed. And a big one: errors or frauds discovered, meaning the financials were wrong. So, rule for existed events is existing condition. I'll write it down. Existing condition plus new evidence equals to existing events. Okay. Now these are. Let's move on to non-existing events. These relate to conditions that occurs after the reporting date. Yeah. So nothing existed at year end. This is all new, which means we do not exist the financial statements. But if it's important, we still disclose it in the notes, which we write below our financial statements. Examples include issuing new shares or loans, big changes like mergers or acquisitions, um, strikes or government actions, fires or floods destroying assets, major asset purchases or sales. So here's your exam shortcut. New event after year end equals to no existment, only disclosure. So new event after year end equals to non-existing events. Okay, so let's move on. Now we'll talk about the what the auditor actually does between the reporting date and the audit report date, because this is where marks are very easy to score. During the period, the auditor is actively looking for any subsequent events that might need adjustments or disclosure. So, the goal is simple: identify anything important that could impact the financial statements. Now, suppose we find something material, but it hasn't been adjusted or disclosed. Then, obviously, we're not staying quiet. The auditor will ask management to make the necessary changes. But here's where it gets serious. If management refuses to adjust or disclose, then we have to think about modifying the audit opinion. Yeah. So yes, this can directly impact the audit report. Now let's quickly run through the procedures auditors perform, and trust me, this is an exam gold. First, we simply ask, inquire with management. Are there any events we should know about? Second, we check their system. Do they have proper procedures to identify events after year end? Third, we go back to solid evidence. Read minutes of meetings because big decisions are always documented here. Fourth, Fourth, review financial data. budgets, forecast, cash flows, management accounts, basically anything that gives us updated insight. Fifth, get a written confirmation. Management has to confirm they've told everything and accounted for it properly. And lastly, check legal correspondence and ongoing risk of contingencies. So, overall, don't just memorize, understand the logic. They also look outside the company, like public news, competitors, suppliers, customers, because sometimes the biggest clues are inside the book. Then they check cash received after year end, especially from receivables. This helps confirm whether debts were actually recoverable. Then they review the cash book after year end to spot any payment or receipts that should have been recorded earlier. They even check the selling price of inventory after year end to see if it was overvalued before. So again, it's all about validating what existed at year end using new information. Now let's move to timelines because exam questions love this. Between audit report date and issues of financial statement, here is the key idea. The auditor is not required to keep checking. But if they come across something, they can't ignore it. They must ask management to amend the financial statements, audit those changes, and reissue the audit report. Now, what if management refuses? If the report is not yet given, modify the opinion. But if the audit report is already given, uh, tell them tell them do not issue the financials. And if they still go ahead and issue it, the auditor has to take action to prevent reliance on the report. Yes, this can get legal, so legal advice is usually needed here. Second, after the financial statements are issued, again, no ongoing duty to check. But if something serious comes up, the auditor must act. Steps include discuss with management, check if amendments are needed, audit those amendments, and ensure that everyone who got the old financials is informed. So overall, timeline trick for exams is before report, you have an active responsibility. After report, you act only if something comes up. And after issue of your audit report, still sorry, still active serious but no continuous checking. And trust me, kids get confused all the time in this thing. Even I used to get confused, so it's better if you write it down somewhere. Okay. uh yeah, one last situation, and yeah, let's talk about it. So let's say the financial statements had to be amended after being issued. In this case, the auditor will issue a new audit report, but this new report will include an emphasis of matter or other matter paragraph. Why? To clearly highlight that the financial statements and the audit report have been reissued. Basically, we are telling the users, hey, something changed, and make sure you're looking at the updated version. Now, worst case scenario. What if management refuses to recall and amend the financial statement? Then the auditor cannot just sit back. They must take steps to prevent anyone from relying on the audit report. This could include informing regulators, taking legal advice, or any unnecessary action depending on the situation. Okay, so now let's talk about going concern. What does going concern even mean? It is the assumption that the business will continue operating in the foreseeable future. In simple words, the company is not shutting down anytime soon. Now, the obvious question, how far is foreseeable future? Generally, we are talking for at least 12 months from the year end. In some countries, it could be 12 months from where the financial statements are approved. But here's where it gets interesting. When we assess going concern, we are basically predicting the future, and future equals to uncertainty. The further you go, the more uncertain it becomes, and all judgments are based only on the information we currently have. Also, remember, subsequent events can completely change the assessment. Now, why is this concept so important? because it actually happens how financial statements are prepared. Normally, financial statements are prepared on a going concern basis. But if management plans to shut down or has no realistic option but to shut down, then we have to switch to breakup or liquidation basis. And this changes everything. First, the company has to clearly disclose why it's not a going concern and why. Why? The assets are no longer shown at normal values, they are shown at sale value, what we can actually get if we sell them quickly. Inventory might be high, sold at a discount, or even scrapped. Receivables may not pay because customers know the business is closing. And on top of that, new liabilities can arise, likely employee redundancy costs, shutdown costs, etc. Okay, so let's talk about who's actually responsible for going concern, and this is a classic exam question. So, first, directors. It is a director's responsibility to assess whether the company can continue as a going concern, not the auditors, the directors. To do this properly, they usually prepare forecast, basically predicting can we survive the next 12 months. And while making this assessment, they consider key factors like current and expected profits. Are we actually making money? Debt repayments. Can we pay back what we owe? Financing. Do we have enough funds or way to get funds? Now, let's talk about disclosures because this is where students often miss marks. Material uncertainty. First, if there's serious doubt about the company's future, the directors must disclose it and not just a vague statement. They need to clearly explain what events or conditions are causing the doubt, what management plans to do about it, and that the company might not be able to realize assets or pay liabilities normally. So basically, full transparency. Second, if the directors couldn't assess going concern properly, for example, not covering the full 12 months, the limitation must be disclosed. And third, if the company is not a going concern, they must disclose the basis used like liquidation basis. So I'll just write down it so it becomes clearly. So directors are responsible for assessment. Remember, it's not the auditor's responsibilities. If uncertainty exists, you need to disclose it. And if not going concern basis, it's easy. You need to disclose that as well. Okay. So let's shift to the auditor's responsibility now for going concern. So the auditor's job is not to make the decision, but to evaluate whether management decision is reasonable. So according to ISA 570, the auditor has three main responsibilities. First, gather sufficient appropriate evidence to check whether management's use of the going concern basis is appropriate. Second, conclude. Is there a material uncertainty about the company's ability to continue? And third, report appropriately in the audit report. Now let's talk something super important for exams. Uh, Indicators of going concern problems. This is where you score marks if you understand the logic. Think of it like this. Anything that shows cash problems, operation issues, or dependency risk is a huge red flag. Let's go through the common ones. Net current liabilities. Can't pay short term debts. Borrowing facilities expiring. Cash access problem. Default on loans. Immediate repayment issues. Selling non current assets unexpectedly. Basically, we're desperate for cash. Missing tax payments. Companies usually never skip this unless they are struggling. Not paying staff. Major working capital issues. Negative cash flow. Over trading, growing too fast without cash. Suppliers not giving credit. Trust issues plus cash problems. Now, some operational risk. Tech changes. If the company can't keep up, they lose customers. Legal claims can't lead to huge payouts. Loss of key staff. Operations can collapse. Over reliance on one product, customer, supplier, or employee loses that one element, that is, business suffers badly. Customers going bankrupt means receivables may never come in. Emergencies of a strong competitor. If customer starts switching, emergence of a strong competitor, sorry. If customer starts switching, revenue drops. Simple. Uninsured or underissued disasters. If something happens and there's no proper insurance, the company might not survive financially. And changes in laws and regulations. Sometimes compliance becomes so expensive that the business can't keep up. I'm going to stop here for today's video, and we'll continue with the rest of the chapter in the next video. If you like this video, if you found it helpful, please like, share, subscribe to my content for more such videos, and thank you so much for watching.